So first of all, welcome to today's event. My name is Jason, and I'm very excited to host you this evening as we dive deep into our Income Plus portfolio. So do allow me to start the event proper with a quick opening statement. So then, sorry, excuse me, oh dear. After enduring one of the worst years on record across all asset classes in 2022, this year 2023 has provided much needed cause for optimism in investors, even as the global economy faces challenges. With fixed income assets widely expected to perform this year, Syfe has recently launched our Income Plus portfolio, which is designed to optimize income for any market conditions. Income Plus is powered by PIMCO, who we all know is a global leader in active fixed income solutions. So without further ado, let me first introduce our speakers for this evening. First up, we have Ms. Alice Low, who is a Senior Vice President and Head of Singapore Retail, PIMCO. She has been with PIMCO since 2016 and has extensive experience in the financial services industry. She graduated from my alma mater, National University of Singapore, and I was just speaking to her earlier this evening, and she is a woman of many talents indeed. She loves to cook despite her busy schedule. Up next, we have Ritesh, who is the Head of Investment and Advisory at Syfe. So if you have joined us for our previous sessions, you will know that he is a veteran of our online webinars and physical events, and he has certainly established himself to be a credible voice of reason. So I know that Ritesh, in his off time, he enjoys a good game of tennis, and he's always up for good, healthy competition. All right. So for the benefit of those of us who are here for the first time today, I will spend a few minutes to give a brief introduction about Syfe before handing the time over to Alice. So what you see here on the screen is actually Syfe's mission statement: to empower people to build their wealth for a better future. Right? These four individuals that you see here on the screen, they are a testimony to that statement itself. Over here, you will see the Syfe Wealth platform and the Syfe Trade platform, both accessible within the same single app itself. So this provides our clients who are able to actually invest in a very holistic and a very seamless manner itself. Up next, what you see here is a quick snapshot of our journey to date. So we launched in Singapore July 2019, right, and we have gone through several significant milestones in a very short time span itself. And of course, our latest Income Plus portfolio launch just last month in April. And that's all. So without further ado, let me invite Ms. Alice Low, who will give us an introduction to PIMCO and a macro outlook on fixed income assets. Ms. Alice.
Hi, evening everyone. Thank you for attending today's event, and very pleased to be partnering with Syfe on the launch of the Income Plus portfolios that's powered by PIMCO. So before I begin, I wanted to share a bit about PIMCO for those of you that are not so familiar with who we are. So PIMCO is a global asset manager that's headquartered in California. We are a US-based asset manager with over 50 years of experience in managing assets for our clients. We are one of the world's largest asset managers, where we manage, on behalf of our clients, 1.8 trillion of AUM globally. So some of you may say we've not heard of PIMCO before, but we've actually been around for a long time, in Singapore even. So just a fun fact, Singapore was actually the first office that we opened outside of our headquarters, and we've been in Singapore since 1996. So we have more than 25 years of experience managing money for investors in Singapore as well. So what is PIMCO's expertise? I would say that our main expertise is managing bonds, managing fixed income for investors. We are one of the world's premier investors within fixed income. We have a very deep bench of resources where we have over 300 portfolio managers and over 80 credit analysts that is spread across all the different areas of fixed income markets. So we have all these portfolio management resources across 14 specialty desks that is just dedicated to the fixed income markets alone. So we will say that we are living and breathing fixed income. So how do we manage portfolios at PIMCO? We adopt both what we call a top-down and bottom-up investment process. Top-down meaning where we are identifying which parts of the financial markets offer the most value. And then from a bottom-up perspective, we look for the best ideas within each of these areas that we've identified that can offer the best value for our investors. And some of the interesting pieces of how we manage this top-down and bottom-up process. If you've attended some of the other investment seminars with other asset managers before, they may tell you the same thing, that they do a top-down and bottom-up process. I would say that something that's different from PIMCO and the way that we do identify that top-down is that we actually hold economic forums 4 times a year. Because we believe in the power of collective thinking. So in terms of how we are identifying value opportunities across the different parts of the financial markets, we don't just rely on the opinions of, say, one person or a small group of economists. We gather everybody's input at the economic forums where all of the investment professionals at PIMCO, we will gather at our headquarters in California to sit down and discuss and debate ideas. We will discuss, for example, what's our outlook on inflation, what's our outlook on growth, etc. What's our view on what central banks will do? So these are actually some of the discussions that we hold every quarter in our headquarters. And not only do we just rely on internal opinions, we also invite external experts to come and challenge our discussions and thinking. So at PIMCO, we have access to a very well-known panel of industry experts, experts in economics, experts in policy making, to really share their very valuable insights with us. So our PIMCO Global Advisory Board, you may recognize some of these faces as well. So the chair of our board is none other than Dr. Ben Bernanke. Dr. Ben Bernanke was the former chair of the US Federal Reserve. He presided over the Fed during the 2008 financial crisis and guided the economy through this very difficult period. So obviously a very important person for us to tap on when it comes to US central bank policy. We also have, I'm not going to run through all of these faces, but on the top right, we also have Gordon Brown, the former UK Prime Minister. So experts in terms of the policy making in UK and in Europe. And also doing Singapore proud, we also have representation in Singapore. Bottom right, the gentleman, Mr. Ng Kok Song, he was the former CIO of our Sovereign Wealth Fund, GIC. So he will actually offer a lot of valuable insights in terms of what's going on in Asia, in China, and that connects us between the East and the West. So you can see that we have really exceptional resources at PIMCO in order to really identify the best ideas in terms of what we think of the markets. And then what we do is that aside from these economic forums, because we only hold these 4 times a year, but markets, news happens on a daily basis. So we also have our investment committee. So this comprises of a group of the most senior portfolio managers and investment professionals at PIMCO, where they actually meet 4 times a week. Okay, so they want to make sure that they are making sure they are keeping tabs on what's happening in the markets in between these quarterly forums. And what they do is then they will discuss and distill all the ideas into portfolio targets that will actually inform all of the PIMCO portfolios. And then what we also do from a bottom-up perspective is we rely on all the expertise that we have across all the 14 specialty desks I mentioned earlier, the 300 portfolio managers, 80 over credit analysts, where then we look and uncover the individual ideas within each of the sectors. For example, regardless of investment grade, high yield bonds, emerging market bonds, developed market bonds, etc. So with that, I want to share what is our latest thinking that is actually emanating from these discussions that I mentioned earlier at our economic forums and also coming out from our investment committee. So right now, when we survey the market for 2023, in our most likely scenario, we do expect a recession in the developed markets, or at least in the US. And why would you say that, so you may ask, why do we think that a most likely scenario is recession? And that goes back to last year, where we see inflation actually spike up to very high levels as a result of the COVID reopening. We are re-emerging from all the COVID lockdowns. And then compounded with the Russian-Ukraine war, that actually caused a lot of the inflation numbers to go up very high across many different markets, be it developed markets, and even in Asia, we are feeling the effects of inflation. So to combat inflation, what we saw was that central banks across the globe, be it the US Federal Reserve, the European Central Bank, the Bank of England, even in Asia as well. So central banks across the globe actually increased interest rates very aggressively to try and control the level of inflation and make sure that inflation does not get out of hand. So of course, there is always a cost to everything. When the central banks increase interest rates, not only does inflation come down, growth also comes down. And the thing is that this happens with a lag. It doesn't happen immediately. If you look at historical data, so we've surveyed historical data going back 70 years, so the past 7 decades, and across 14 developed economies, history suggests that from the time when the central banks start to hike rates, from the first interest rate increase, how long does it take for the economy to start to contract and go into recession? Typically is around 6 quarters, so 1.5 years. The Fed started hiking rates, was one of the first to hike rates. They started hiking rates in March last year. So I would say that we are 4 quarters, 1 year into the rate hiking cycle. So history will suggest that in the next half year, we are likely to see a contraction in economic growth and recession. And we are actually starting to see signs of that. If you recall, in the last 1 to 2 months, there's been a lot of volatility in the banking sector. So it started with, in the US, with the Silicon Valley Bank running into failing. And then we also saw First Republic Bank, PacWest. These are names that you are reading in the headlines. So there are clearly signs where the economy is starting to come under stress. And these are actually symptoms of these monetary policy working through its way, working through the economic system. And then going ahead, we expect that, especially with some of this banking sector stresses, regulators have started talking about tightening regulations, and also some of these small and medium-sized banks, we think, are likely to start to focus more about managing liquidity, starting to pull back on lending, and that will have a ripple effect, because if you look at last year, these small and mid-sized banks that are in the spotlight recently, they actually contributed to about 30% of the lending to US companies and households. And when these banks actually pull back the lending, this will cause a bit of a credit crunch, and in turn lead to lower growth and more slowdown. So that's why we think that in the most likely scenario, we do expect a recession. Of course, this means that that lifts the burden off the central banks to hike rates more aggressively. And if you look at last week's Federal Reserve meeting, Jay Powell actually, even though they hiked one more time, 25 basis points, that brings the US Fed funds rate now to 5.25. But Jay Powell also signaled that the Fed is likely to pause, and we don't think that they're going to hike anymore, because we can see that some of that pullback in credit and lending, that will also have a bit of effect on the economy. So it kind of lifts the burden from the Fed to hike rates more from here. But at the same time, okay, so if you think that the base case most likely scenario is a recession, what's the Fed going to do about it? What are the central banks going to do about it? What are the governments going to do about it? If you look at the last 15 years since the 2008 financial crisis, we've actually seen that recessions are relatively short-lived. Whenever we've seen a recession, there's been a pretty quick recovery, and that's because in the past 15 years, central banks and governments have been very quick to come to the rescue by cutting interest rates down to 0, by providing quantitative easing, helicopter money. Governments have been providing a lot of support, spending, stimulus, subsidies to support the economy. But this time around, we think it's a bit different. If you look at why is that the case? Number one, let's look at central banks first. If you look at central banks, we do think that they are unlikely to cut rates very aggressively even as the economy slips into recession, because inflation, whilst right now it is starting to come down, we are starting to see signs that inflation is moderating, we don't think that the inflation is coming down fast enough. So this slide over here shows you the level of inflation, core inflation, which strips out your food and energy, those more volatile elements of inflation. And you can see that last year, inflation went up very sharply, but that a lot of it is contributed by the green portions. You can see that the green portion went up, and that is actually inflation caused by goods, right? So as we emerge from the lockdowns, as economies reopen, there's been that pent-up demand for goods. So that actually caused a lot of the inflation, but that has actually started to come down, and that's replaced by the blue portion. So that blue portion is actually services-related inflation. So that, a large part of that is wages. And if you look in the US, the unemployment rate is still very low. The current unemployment rate in the US is at 3.4%. That is even lower than pre-COVID levels. So right now, actually, the jobs market in the US is actually still going very strong. We think that wage inflation will continue to remain quite sticky, and that will mean that inflation is likely to stay a bit higher for longer. We do think that in the US, we are likely to see inflation and the end of this year at around 3%, which is lower than current levels of around 5.5%. But at 3%, that is still above what the central banks are targeting, which is about 2%. So as long as inflation continues to remain above the target levels, we think that that will constrain the limit, the ability of the Fed and other central banks to cut rates aggressively to combat inflation. So we do think that the Fed is likely to only start cutting rates at the start of next year. How about governments? We also think that governments are also unlikely to come to the rescue, because in the past few recessions, governments have already done a lot of spending. So if you look on the left-hand side of this slide over here, the left chart shows you the level of debt that governments are holding on the, as a percentage of the overall GDP. And you can see that across all the developed markets, it's very high. It's actually 100%, if not higher. So governments actually do not have that firepower or ammunition to do a lot of spending. And you can see on the right-hand side, our expectation is that the government spending will be getting lower and lower, because, again, debt levels across many developed markets are at record high levels. So this means that from overall, what does this mean in terms of the investment implication is that we are expecting most likely a recession. It is going to last for a bit longer because there's going to be limited support from both central banks and governments. It also means that we are not expecting a lot more rate hikes, for example, from the Fed. We do think that the Fed is at least done for this round of rate hike cycle. So a recession that will last longer, but at the same time, this is good news for bond markets. We do think that in this current environment, bonds actually look more attractive as an asset class versus, say, your equities, the stock markets, or even versus cash. Because as we expect the Fed to already reach the end of the rate hike cycle, that means that there is actually a lot of support for bond prices, because as interest rates go up, bond prices fall. So that was what happened last year, but because we are not expecting the Fed to hike rates anymore from here, we do think that the bond prices have pretty much bottomed out. So there's more upside in bond markets. At the same time, a lot of, so some of you may ask, if let's say there's a recession, but it also means that it could be a good time to buy the dip in equity markets. We do think that right now bonds look more attractive because historically in a recessionary environment, bonds actually have been the best performing asset class. So again, looking at data, going back the last 70 years, right, since the 1950s. Since the 1950s, in the last 70 years, there have been 11 recessions. And in the past 11 recessions, you can see that on average, there is only 2 times in the last 11 years where equities have not had negative returns. So typically, this is quite intuitive. In a recession, typically stock markets don't do very well. And the average return you get in a recession environment in stock markets, down 8.6%. comparing that to bonds, so the second column, in contrast, the picture looks very different. In a recessionary environment, bonds typically deliver positive returns. There was only 1 year where bonds also had a negative return. And on average, bonds delivered 4.6% in a recessionary environment. So on average, in the past 11 recessions over the past 70 years, bonds outperformed equities by 13% during a recessionary environment. So that's already a very strong reason why we think that bonds are like a better option in this current environment versus equities. Now, some of you may also ask, well, maybe the Fed might not cut rates now, but at some point in the future, you just mentioned that the Fed might start cutting rates next year. If the Fed starts to cut rates, that's also good for equities. Why don't I, again, buy the dip in equities? But if you look again at the historical data, regardless of whether the Fed continues to pause or actually cuts rates, bonds actually, in this kind of environment, have actually been a better performing asset class versus equities. So the left-hand side, you show that when the Fed pauses, on average, equities are down 20%, and then bonds flat. And then in contrast, when the Fed starts to cut rates, it's good for equities. Equities recover, up 7.7%. But actually, bonds benefit even more. Bonds have been up about 11.8. So bonds, when the Fed actually starts to cut rates, bonds tend to outperform stocks in this kind of scenario. And why do I say that it's probably not the best time to buy the dip in equity markets? We do think that in order for us to be more positive in the stock markets, we need 3 conditions. We need, number one, interest rates to stabilize. We've kind of seen that already. The Fed said that they'll pause. But number 2 and 3 has not been met. So number 2, we need current equity prices are not reflecting a recessionary scenario. So right now, we think that equities are overvalued. So they are too expensive. Currently, if you look at S&P 500 as a proxy, the current price to earnings ratio for S&P 500 is around 18.5, close to 19. Compare that to the typical price earnings ratio during a recessionary environment, which is closer to 14, 15 times. We think that right now, equities are looking expensive. So you need actually equity prices to come down, right, in order to reflect the potential recession. And then similarly, when you look at the estimated earnings, so the forecast for earnings on the S&P 500 is extremely high right now. You look at it, the expected earnings for S&P 500 is at 12.6%. That's actually very inconsistent, right? Because that's even much, much higher than what we've experienced in the last 2 years. And when we are expecting a recession, typically in a recessionary scenario, earnings do come down. And the average earnings growth in a recession is actually down 14%. But right now, despite all the elevated recession risk, all the risk about having economic slowdown, equities are right now pricing in expected earnings that is double digits. So we do think that right now, based on the metrics, stock markets look actually pretty expensive and overvalued. So we do think that bonds look a lot more attractive relative to equities, which is why in our portfolios, we are generally, in some of our multi-asset portfolios, we are underweight on equities, and we do favor fixed income as an asset class. And of course, within fixed income, it doesn't mean that all bonds are equal. We also want to be very selective. So given the higher recessionary risk in the market, we also want to stay higher in quality. So we will favor some of the higher quality investment grade bonds over high yield bonds. We'll also favor some of the securitized assets that have, say, hard assets that's backing these bond investments. So generally trying to stay more resilient and going up in quality. And then the final thing I'll just talk about is also then, okay, we've talked about bonds versus equities. How about bonds versus cash, right? If you look at, for example, 6 months SGS bonds right now, it's giving you 3.75, pretty good. It's 3.75 risk-free for 6 months. Why not? So why should we look at bonds? A lot of people think that cash has no risk. Well, it's true that there is no default risk, especially if you're looking at SGS or fixed deposits. But there is also a risk associated with cash, and that's called reinvestment risk. Say you actually right now invest in a 6 months SGS bond for 3.75%. It will mature 6 months later. 6 months later, are you able to put that same capital back at the same rate? Maybe not, because if interest rate starts coming down, your fixed deposits, your SGS bonds, the yield will come down as well. So there is reinvestment risk. And with fixed deposits, with cash, there is no capital gain. What you put in is what you get. Whereas for bonds right now, first of all, bonds are actually, because of the rise in interest rates over the course of last year, bonds are offering you very attractive yield right now. Bonds right now, even if you look at this chart shows you the yields you're getting across different parts of the bond markets. Boxed up on top is what we call the highest quality core bonds. So this would be like your AAA rated, the highest quality bonds within the markets. And these are actually still giving you around that 4 to 6% yield level. So higher than what you're getting in cash. And at the same time, if interest rate starts to come down in the future, bond yields and bond prices move in opposite directions. So there's also potential for capital gains. So that is what cash cannot offer you as well. So we do think that right now, because of the higher yielding environment, because of that potential for capital gains, if interest rates start to fall sometime, say for example next year, we do think that bonds also offer a very attractive opportunity versus cash, because at the same time, not only can they offer you higher yields, potential capital gains, it also provides that diversification from equity markets. So we do think that right now bonds look very attractive versus equities as well as versus cash as well. So I hope that that has been helpful. I'm going to pause here. I'll be back for Q&A later, and I'll pass the time back to Jason. Thank you.
Right, thank you very much, Alice. So next up, we have Ritesh, who will share with us more about the Income Plus portfolio. Ritesh, please.
Hi everyone, it's a pleasure to be here again today. Thank you so much for coming in and participating in today's event. Now, if Alice did not convince you enough, I am here to convince you even more why you should look at fixed income and, more importantly, into our Income Plus portfolios. So just a quick recap. Of course, 2022 was a tough and challenging year for the markets, right? You saw the equity markets dropping by more than 20%, and the Fed kind of embarking upon its rate hiking cycle, which was one of the fastest in many decades. Now, 2023, of course, began, as Jason also mentioned, in a more positive note, but we also saw the Fed kind of remaining steadfast in its approach to keep the interest rates moving up, such that the sticky inflation that you see in the market can be handled better. That also had led to a little bit of a stress in the market with respect to certain banks collapsing, such as SVB, as well as the takeover of Credit Suisse by UBS. So now we are at a stage where basically investor confidence into the markets been shaken a bit. And that basically has pivoted them to look at safer yielding assets. So if you, wrong slide. Yeah. So if you see, this is what the state has been. The search for safer and higher yielding assets have really surged in the last year, and Singaporean investors are seeking higher returns, but they're also looking at more stability in their portfolios. Now, while the returns from these instruments look attractive on a standalone basis, I think Alice covered one aspect of it in terms of the reinvestment risk, but the other risk that you tend to think about is the fact that these still do not match up to the current inflation numbers. And right now, inflation is still running hot north of 5%. And if you see some of these instruments, they're yielding between 3.5%, and maybe touching 4%. So this is where I guess when you look at your real returns, the real returns are still negative. And as Alice covered, on the equity side, things are still volatile, right? So investors are kind of like a bit divided as to where should they look at in terms of investing their money at the current juncture. Which brings us to the point on like how fixed income can be a key asset class, not just to kind of navigate through the current markets, but also to be a core part of investor portfolios who are seeking not just returns, but also kind of income and cash flows in the current environment. As you can see from this slide, the role of fixed income actually is kind of multifold. Now, on the diversification side, of course, this was called into question last year when the stocks and bond market kind of moved in tandem and both of them fell amidst the rate hiking cycle by the Fed. But come 2023, we believe we are seeing that the fixed income market, number one, has much higher yields, and there is a cushion when it comes to volatility within the prices, because as we are reaching peak interest rate, the upside risks of fixed income is relatively reduced. And at the same time, I guess the negative correlation between equities and bonds are kind of reestablishing itself. Apart from that, as I mentioned earlier, income is kind of finally back into fixed income, right? And it can also kind of have an impact in terms of being your downside protector, right? If interest rates maybe keep moving up a little bit more, you're still having those cash flows to kind of cushion any price volatility at this juncture. Also, compared to traditional fixed income such as T-bills, SSBs, all of the other things that we had discussed before, a diversified kind of fixed income portfolio can actually better insulate you against inflation over the long term. So I think the bigger question again is why fixed income now? I think 2 points, right? Like, number one, we are reaching peak interest rates. So the upside risks of interest rates is relatively limited. On the other side, income, as I said, will protect you from the standpoint that since the yields themselves are elevated, that provides you cushion in terms of price movements. If you look at this chart, I think what it kind of depicts is historically, when yields are at levels what you're seeing right now, the forward 5-year returns are much, much attractive. And this is not just in one sector of fixed income, it is across the different fixed income sectors. And the good news is you do not really need to take excessive risk, right? Like, back, just a couple of years back, you have to take a lot of risk either on the credit side or on the yield curve to generate higher interest income. But right now you can pretty much invest into investment grade corporate credit, and the current yields are standing at 5.5%. And then if you look at a forward 5-year projection, that could translate into close to 6% overall returns on a per annum basis. So from a risk reward standpoint, that looks pretty attractive. So in summary, I guess like fixed income provides very compelling opportunities at the current juncture. We are seeing elevated risks of recession that was covered by Alice, that there could be recession and it can be pronounced for a bit longer. But any price pressures that are put on the equity side, there could be protection that you can see from the fixed income side. As we kind of continue to see the monetary policy easing up, that basically again translates into the interest rate risks on the upside being fairly limited. And last but not the least, again, record highs in terms of the yield levels at the current juncture. And that basically means that from a forward-looking standpoint, fixed income provides a better risk reward in terms of returns. And this is essentially why we have worked tirelessly over the last 3 months to kind of come up with a very unique fixed income solution that is our Syfe Income Plus and powered by PIMCO. So let's take a sneak peek as to what Income Plus is. Great. So I think there is a very interesting story about the terrarium that you're seeing there as well. It is supposed to act as this evergreen tree that keeps giving you, fruits of labor. And there are two variations of it as well, where, on one side, there is that more steady flow of income coming. And on the other side, there is that, higher income flowing through on a faster pace as well. So in terms of Income Plus and what is the uniqueness about it, it is really a first of its kind offering where we have partnered with PIMCO, a global leader in active fixed income, to build these portfolios and generate sort of the best outcomes that are possible for all your income needs. This is the first time that PIMCO, with over 5 decades of expertise in fixed income and with a proven track record, has partnered with us, Syfe, who are a leading digital investment platform with the trust of over 100,000 Singaporean clients. This partnership actually allows Syfe to use the best-in-class underlying active funds from PIMCO's fixed income product suite, but also allows us to use their forward-looking market views and time-tested investment approach to construct these portfolios and optimize your income in any market condition. Coming back to some of the key features of the product that we have built, we have really focused on when someone is investing into income, what are the problems that they're trying to solve for. You want steady returns, you want consistent cash flows, you want things that are regular in nature. So we have consciously chosen funds and underlying instruments that can give you regular passive income. And that's why our portfolios can generate between 4 to 6% monthly income that is directly credited to your bank account. In terms of, there is this thing that, okay, active funds, they're good, but they're so, costly. We have consciously again spent time to make sure that we take the institutional share class funds predominantly from PIMCO's fixed income product suite. That significantly reduces the fund level fees that you end up paying. Because typically if you access the retail share class, it will cost you, north of 1.5% typically. But because we are using the institutional share class funds, the cost is reduced by more than 60%. On top of that, there are all the, benefits of investing into a diversified pool of fixed income assets, which is you don't have to worry about liquidity. You don't have to worry about, if I withdraw, is there a penalty? All of these things are taken away. Typically, if you invest into FDs, if you want to, if you have immediate liquidity needs, those things are very hard to kind of get because your money is kind of locked up. So there is no withdrawal penalty, there is no lock-ins, there is no holding period. In terms of the two portfolios, what we thought of was really focus on the key objectives and needs of clients. And when we talk to a lot of our clients, we got to know that different people have different needs. And this is where we thought of constructing two different portfolios. One portfolio for people who are generally looking to preserve their capital, but still getting a regular, steady kind of income on a monthly basis. On the other side, there are investors who do want the income and return, but they also want to get some sort of a capital appreciation. And that's where the enhanced portfolio gets you that kind of objective. In terms of the strategy, if you look at the preserve portfolio predominantly invests into investment grade quality corporate credit. And that basically means that you're investing into very high quality instruments, and that kind of provides you an overall stable kind of investment profile. Versus on the enhanced side, it focuses a lot more on the credit side of things. It takes, exposure to high yielding instruments and also emerging markets, and that kind of enhances the overall yield of the portfolio. A little bit more risk, but you get a higher yield overall. In terms of how the returns and other characteristics look like for the preserve portfolio, the yield to maturity, and this is a term that we'll explain more as we go along, is 6.4%. For the enhanced portfolio, the yield to maturity is 8.2%. And then both of these portfolios pay out on a monthly basis in terms of dividends. So the dividend yield or the distribution yield of these portfolios on the preserve side, 4 to 4.5%, and on the enhanced side, it's 5 to 6%. Now, again, I think coming back a little bit on the difference between yield to maturity and the monthly payouts, typically yield to maturity gives you a sense that if you hold all your bonds in your portfolio to maturity, then what is the kind of return or yield that you will generate on those instruments, versus the monthly payouts typically give you a sense of the cash flows that are generated on a regular basis from these instruments. So now the reason there is a difference between the two is because we have come off from a low interest rate environment to a high interest rate environment. And because the bonds in a typical portfolio, you don't change them overnight. You kind of hold on to them, and then, as they mature, then you kind of reinvest them. So bonds that were invested in historically, those typically had lower coupons. And that's why the monthly dividend profile, tends to lag the YTMs in general when the interest rates are kind of moving up, and, the reverse way as well. So the expectation should be that the monthly payout should start moving closer to the YTMs as we move forward. And the YTM also kind of gives you a guidance as to, what kind of overall returns can you expect from this portfolio on a long-term basis. Now, coming to the investment process, I guess this is the core part of how we have thought about the portfolios in a way to kind of bring in the institutional level expertise from PIMCO's side as well. And there are three core components of how these portfolios are designed. We have the forward-looking investment views, we have a broad definition of the opportunity set, and then there is the analytics kind of infrastructure. In terms of the forward-looking views, typically as yields rise or credit spreads widen, fixed income assets tend to drop in value. But on one side, typically investors will at these points, take money out and try to redeploy because they're losing money. But on the other side, you can also see it as an opportunity because the future returns actually look much more attractive. And this is where the PIMCO's forward-looking views come into play, where they're constantly seeking to position the portfolio to best capture opportunities in terms of future return potential, and also provide some sort of a discipline into your fixed income investing process. Coming to the second point on the broad investment or the broad opportunity set, typically we have been proponents of investing in a passive basis, right? When you're investing into growth related assets, you should invest in a passive ETF based manner. But, and it has been shown that historically ETFs and index tracking, instruments are better compared to active funds when it comes to returns. The active funds tend to, underperform a lot of these benchmarks. But when it comes to fixed income, actually the, things are reversed a bit. And again, if you are working with a top quartile manager such as PIMCO, then potentially you can do much, much better within the fixed income world because there are so many things to optimize for, especially on the credit, profile as well as the interest rate curves and all. On top of this, overall, fixed income is kind of a precision game, right? You really need to look through the individual bond holdings and see where you can optimize and, identify opportunities. And this is where the forward-looking process as well as, their infrastructure helps in us kind of deciding what is the right way to construct the portfolios and also stress test it against, potential market drawdowns. So in terms of the overall process, it's really a three-step process, right? We have the first part of defining the opportunity set. And this is where I guess when I talked about the two portfolios and the different objectives of the two portfolios, each investor is different and each investor wants different kind of, returns. And they have different things that they're trying to solve for. Some are seeking capital preservation. Some are investing into the market because they want to diversify away from the equity markets, or you simply want to get regular cash flows. And these are things that, we can optimize for using the construction process versus, if you are just investing into one fund, it becomes a very difficult process for you to think through, while it will solve my need for now, what if my new needs emerge and how do I construct it in a manner such that all my needs are optimized as well. Overall, then we combine it with the forward-looking views of the market, and then the whole process is kind of optimized to make sure that the process kind of defines the overall allocation guidance, and it is also qualitative inputs from the PIMCO's PM team comes into play such that short-term views can be incorporated as well. Going a little bit more into the highlights of the portfolio, So this is how the preserve portfolio looks like. The yield to maturity, as I shared earlier, was 6.4%. If you look at the top characteristics of the portfolio, duration is a measure of interest rate risk. Typically, if the duration is longer, then you have higher interest rate sensitivity. So if interest rates move up or down, then if you have a very long duration portfolio, that will have much more variations. So we've maintained the portfolio duration quite effectively around the 4.5 year mark. In terms of the credit quality, as I said earlier, because it's a preserve portfolio, we want to make sure that the overall credit quality is very, very high. So the average credit quality here is A+. And then we have another measure, which is more like a risk measure to kind of give you a sense as to how risky this portfolio is. A beta to the equity market kind of tells you that if equity market move by 1%, the 0.12 basically denotes how much in percentage terms this portfolio should move. So if equity market's 1%, then this will move by 0.12%. In terms of the overall exposures, you can see that the preserve portfolio is predominantly investing into very high quality assets, government securities, securitized assets, non-developed but non-USD but developed assets as well. And the emerging market exposure is kind of limited below 15%. And similarly, from a country exposure as well, bulk of the investment, of course, in the US, but overall, it is still very much into the developed and dollar block economies, and the emerging markets again only contribute close to 10% of the portfolio. Compare that with the enhanced portfolio. So again, the yield to maturity is much higher. The duration is actually a bit lower compared to the preserve portfolio. The credit quality slightly lower at A-. And as you can see, again, from a risk standpoint, the beta 0.22, that basically denotes that, compared to the preserve portfolio, which will move by 0.1%, this portfolio might move by 0.2% if the broader equity markets move by 1%. In terms of exposure, again, you can see that in this case, close to 50% of the portfolio is more onto the US government securitized as well as investment grade assets. And the other 50% is more exposed to your high yield and emerging market economies as well. Similarly, in terms of countries, US still dominates, but again, you can see the emerging markets kind of contributing close to 27% of the portfolio. Now, if you look at a little bit more details of the funds that we are using in the portfolio, it kind of encapsulates all the points that I had mentioned earlier. When we are choosing, the science that goes behind the choosing of the individual funds, this is where we want to make sure that in the preserve portfolio, we have chosen funds that are very, aligned to preservation elements. Their objectives are more preservation oriented as well. And that's the reason these are global, but we also have Asia and other kind of exposures. The YTMs, the distribution yields, the credit quality, all of them, you can see that they're very up in quality. And that's the reason you see the overall, allocation resulting in a yield to maturity 6.4% and the distribution yield, which is somewhere in the middle point of the 4 to 4.5% range that we had given. Similarly, on the enhanced side, then you can see that you have a little bit more risk being taken, right? You have Asia high yield coming in. So Asia diversified high yield fund coming in, as well as more multi-sector global funds kind of coming in, which kind of enhances your overall yield. And if you look at more on the Asia side, the yield to maturity is, very high. And similarly, the credit quality drops a little bit onto the B sections, triple B, double B, those kind of things as well. So the overall credit quality is still pretty high because the allocation is done in a way such that we still achieve a relatively high credit quality. All of these, both portfolios are paying on a monthly basis, but both of these portfolios have a small component to one fund which does pay on a quarterly basis. So there might be a little bit, variation on a month-to-month basis, but usually you can expect the portfolios to generate the yield projections or the estimated yields based on historical, like the last 3 months values to kind of persist. I was talking about this in terms of cost. So this is where the cost effectiveness comes in as well. All the funds that we are using predominantly are institutional share class. Even if we use retail funds, then there is, trailer fees that we get back from PIMCO, and we 100% pass those trailer fees back to you. And that's the reason the overall fees that you see that you pay up is 0.65% or 0.68%, depending on which portfolio you're investing, compared to if you do it DIY, especially on retail platforms, the fees can be, more than 1.5%. So that results in up to 60% of savings. Overall, if I have to just summarize some of the key highlights of the portfolio, again, monthly payouts, no lock-ins, unlimited free withdrawals, active fund management, SGD hedged. So this is another important point, that you don't need to worry about currency risks, and you can expect the monthly dividends to be pretty smoothly managed as well. Diversified and tax efficient. This is another very important point, because typically when you invest into, say, ETFs and other such instruments which are US domiciled, there are implications when it comes to dividend withholding tax. All the funds that we are using in our portfolio are Ireland domiciled, and that basically means that you can save up to 30% of dividend withholding tax with Income Plus portfolios. There's a quick slide that I did just to kind of show you risk versus return characteristics of the different instruments that you can take exposure into, and what kind of, overall returns that you're generating. So again, putting in, things like SSB, fixed deposits, T-bills, and the current kind of rates that they are giving, and then comparing it a little bit with Income Plus, Preserve, and the Enhance. And as you can see, from a yield to maturity standpoint, they give you much, much better yield. Plus they're giving you, cash flows on a monthly basis as well. Again, yes, I mean, Income Plus, preservation does not mean capital is guaranteed, but they're relatively low risk, they're very well diversified, and they're very, very liquid. And that is very important, considering all the facts that we had shared earlier as well, in terms of like reinvestment risk and all other risks considered. On a risk reward basis, you're getting a much better bang for your buck when you're investing into Income Plus portfolios compared to a lot of cash instruments. And you're also able to kind of like match or exceed the inflation targets to kind of get real returns as well. And that kind of also completes our offering suite, right? Like, when we were thinking of Income Plus portfolios, what we really wanted to do was provide a range of cash and income based solutions for our end investors, such that you have a full suite, right? And this is where, if you look at our offerings, we actually have a lower risk cash management solution that you can invest into, and it is giving 3.5%. It is, I think, projected to increase to 3.7% over the next few days. But again, if you want to beat inflation in the long term, then Income Plus, Preserve, and Enhance could be ways for you to do it. And then if you want to take a little bit more risk, then there is the REITs portfolio, which we have built again in partnership with SGX. That could be another way for you to not just earn income, but also have, greater price appreciations. This is, kind of trying to wrap it up with the overall suite of Syfe's offering. So while I concentrated on the income section because that is the theme of the year, Syfe actually is a place where essentially you can think of managing and growing your wealth on a holistic basis, right? So while the cash management, the Income Plus, and the REIT portfolios are more kind of yield-based solutions, we do have core portfolios that can cater to your long-term growth needs, right? And if you're thinking of retirement planning, if you're thinking of children's education, you want to buy a house, all of these are growth-oriented portfolios, and for them, you do need to take some equity risk to kind of maximize your overall returns. So there are core portfolios and thematic portfolios to kind of take specific exposures and well. And then there is also a lot of flexibility that we provide. We have custom portfolios where you can self-select your own underliers and construct your own portfolio. And on top of that, we also realize that people do want to express themselves in terms of taking exposure into individual securities. So we have a trading platform through which you can invest into both the US and the Singapore markets. I think that is all the things that we had to cover, but yes, so there is a promo too. So if you are looking to invest into Income Plus, we are running this promo where essentially the more you invest, the more fee waiver you get, ranging from $10,000 to above $100,000, and you get a lot of your fees waived for at least a certain duration of time. Okay. Thank you so much. We'll be back in the Fireside Chat.
Yes, yes, Ritesh, please stay here. So may I invite Alice up on stage? Okay. All right, so Alice, Ritesh, please take your seats. So as we proceed to the next segment, the QR code is on screen as well. There is a poll. Please do fill up the poll. We will go through those poll results very shortly.
doing the polls now?
Yes, so let's segue into the poll results. Desiree, please. Right, so I thought before we start with the fireside chat, it'll be a good chance for us to take a look at what's on everyone's mind right now. So these are some of the questions and the results. So as we approach the second half of 2023, what are your expectations for the economy? And I think most of us have recovery on our mind. There's a bit of fear, uncertainty, flat. Obviously, recession is on everyone's mind. It's grown a little bit bigger since it has grown very big. All right. Next one. Right. What are your current sources of passive income? Looking at dividend-focused portfolios first, fixed deposits, and then followed by bonds, rental, and others. Right. And the next one. What allocation would you set aside for fixed income assets in your portfolio below 20%? It's actually the majority. Oh, all right. Do you think that this is a year for fixed income? 60% said yes, and 40% not too sure. So perhaps, Alice, we'll start off with you first. Any quick thoughts about the poll results?
Well, I think if this is the year for fixed income, then I would encourage everyone to have a higher allocation to fixed income in their portfolios.
All right, and Ritesh?
No, absolutely. And I guess the reason the numbers showed up the way they showed up is because predominantly a lot of our investor base tend to be the younger investors who are really looking to solve for their core growth needs. And that's where the portfolio tilt is a little bit more towards equities. But again, I think if you look at where we are in the cycle, I think income and income-based solutions could be a pretty good setup for you in the current environment. Also, if you look at typically when you are thinking about a moderate investor, right? You think about 60-40 allocation. Now, obviously 60-40 was called into question last year, but when it comes to the kind of nominal returns that you can get from a 60-40 portfolio versus the returns that you'll potentially generate from a full equity portfolio, actually, from a risk reward standpoint, 60-40 portfolios nominal returns have increased significantly, close to 7 to 8% compared to close to 3% just a year, 2 years back. So that's where I think from an opportunity standpoint, you don't really need to take too much risk to kind of generate high single-digit returns in the current environment, and bonds can be that place where you're reducing that risk as well.
And also, if you're looking to overall reduce the volatility in the portfolios, we do actually think that you need a higher allocation to bonds. You just now mentioned, Ritesh, a 60-40 portfolio. Actually, if you break down the risk, because equities are much more volatile than bonds, in a 60-40 portfolio, do you know that actually 90% of the portfolio volatility is driven by the equity allocation? So in order to actually bring down the overall volatility, you need actually much higher allocation to fixed income than just 40% as a starting point.
Absolutely, and this is one of the slides that we used to have previously when we, again, talked a lot about asset allocation, and asset allocation does not mean 60-40 in equity bond, but because it has traditionally been the default portfolio that people have gotten accustomed to, so that is used as an example. But as Alice mentioned, 60-40 doesn't mean that your risk is 60-40, it's actually more 90-10 or even more.
Yep, 100% agree over there. Right, and I think that would be a good segue into the fireside chat. So we do have 3 questions, but I think the first question, Alice actually covered it very well in her presentation earlier, right? Where it comes to, you talk about why should we consider bonds now compared to next year or even perhaps last year? And of course, if you talk about the rising rate of interest rates itself, and what happens to bond valuations when interest rates do rise. So she's covered that pretty well. So I think we'll skip the first question and look at the second question, which I know for a fact that a lot of investors are actually wondering in recent times itself, because you talk about the diversification of ETFs, there are a lot that actually sprang up in the recent times. So if an investor were to be looking at this, what is the main benefit of investing in an actively managed bond fund as compared to a lower cost bond ETF itself?
Maybe I'll take that first. Ritesh can add on. I think Ritesh already made a very good point just now, where you talk about when you invest in ETFs. First off, you already have the 30% withholding tax, so that's one thing to just keep at the back of the mind. But even without taking this 30% withholding tax out of the equation, in bond markets, actually it makes a lot more sense to be investing in active bond funds. We've done some research that shows, if you're in equity markets, actually the average active manager in equity markets, average equity manager does underperform ETFs. But the opposite is true in fixed income, where the average bond manager actually outperforms ETFs and even the benchmarks. Why is that the case? There are a lot of reasons, but just to name one or two. So in the equity markets, why the average manager will underperform is obviously transaction costs, tracking errors. And that's because in the equity markets, the cost of replicating the index is pretty low, so ETFs are quite efficient. And that's because in equity markets, the index does not change frequently. So call it, for example, you buy an ETF that's tracking S&P 500, the 500 stocks don't really change that often. So ETFs are very cost efficient. But in the bond markets, bond indices, they actually change a lot because bonds have maturities. So every time a bond matures, it gets out of the index, a new bond gets added to the portfolio. So on a natural basis, even if you're buying an ETF that's tracking a bond index, you already incur a lot of transaction costs. So ETFs that are bond ETFs tracking a bond indices already have a lot of transaction costs involved. And also in the bond markets, one company can issue many different bonds. So in the stock markets, every company probably has 1-2 tickers across different stock exchanges. But in bonds, one company can issue tens or even hundreds of different types of bonds. So even if you like that particular company and you want to buy a bond that's issued by the company, there's so many different bonds to choose from. So as an active manager in bonds, there's a lot of opportunities for us to add additional value by looking through all these different issues.
Yeah, absolutely. And I think, Alice mentioned the average active manager outperforms in the fixed income world, and we're talking about the top quartile asset manager with respect to PIMCO used in our portfolios from that perspective. But again, like coming back to the point that when it comes to active management, there are a lot of things to play with when it comes to the fixed income side. The credit curve, the yields, the interest rates, these are very dynamic. And when you are investing with an ETF, you're very constrained because they just have to follow the index. And what that means is it is very hard for them to juggle around these nuances and optimize for better returns and income. And that's where the role of an active manager kind of comes into play.
Agree. Yeah, and I think when it comes to the portfolio construction, perhaps the next question I'll ask Ritesh, right? So when it comes to investors itself, I think a lot of times we ask ourselves, why should we consider a model portfolio of bond funds as compared to actually directly buying a bond fund itself? Given the fact that the bond fund, the underlying is already diversified, and also in terms of being managed, is already actively managed.
Yeah, I think that's a great question, and this is one of the things that a lot of people ask us, right? What is the value that we are providing by combining a lot of these bond funds? I think I'll go back to my previous point where we kind of showcased our investment process, which is powered by PIMCO's forward-looking market views. But more importantly, I think the more important aspect of that process is the fact that each investor has a certain specific need or objective, right? And each bond fund, when you are trying to invest into them, they also cater to a very specific, say, credit sector or duration profile or a certain sort of an objective. So some funds are meant for capital preservation, some funds are trying to optimize for total returns, some funds are taking exposure into emerging markets, into credit in a way such that they achieve a certain kind of rate of return, and they also expose you to those kind of certain risks. Now, when we think about our investor base, you need to kind of match it, right? These are the different bond funds that are available, and again, there is hundreds of thousands of such funds. How do you kind of bring them together in a way such that there are trade-offs, right? Like if you combine one preservation with a multi-asset with a high yield, how do you decide what allocation is best to kind of get the right outcomes for your specific needs? So if you're thinking about preservation, then you need to have the right kind of elements, number one, but also combine it in a view such that they will give you optimized returns. So that is where I think the construction process is very important. The thoughtfulness around it is very important. And the fact that, again, you are going beyond and evaluating, and I think Alice covered it really well in terms of, they have a 3-step process where you have the economic forums, you have, the investment committee, and all of those things kind of coming together to kind of guide the forward-looking views in the market. So it is not just like, a systematic process which is backward-looking, but it is kind of a forward-looking process that drives that asset allocation as well.
Maybe I'll just add on a couple of points. In our partnership with Syfe, where we optimize the portfolios, and another thing that we do is because we know what is in our funds. So we have actually the look through of the underlying of each of the funds that we manage. So we also are able to see, for example, within the funds that we manage, the bonds that we have, what's the correlation, right? So if as a DIY investor, you might not know what is actually inside every single bond in the portfolio. So so sometimes these correlations come into play when we also optimize the portfolio as well.
Well said. I do agree with that in terms of the being able to see in terms of the different bond funds itself and the correlation. That is something that I think as a retail investor, it is pretty hard to actually discern on our own. So I do agree with that point. Perhaps now it's a good time, and given time constraints, we will look at the viewer questions itself. Desiree, if you don't mind, can you just show me the Slido? Yes. All right. So perhaps the first question, I will pass it to Alice, maybe. You can take the first question. So how safe are Asian high-yield bonds in this current environment?
Well, okay, by nature of high-yield bonds, they're naturally higher yielding and higher risk compared to investment-grade bonds. So I think investors going into high-yield bonds need to understand that. Having said that, we do find value in Asia high-yield specifically. The Asia high-yield markets have actually been under a bit of stress in the past 1 to 2 years. But at this juncture, we are a lot more positive on the Asia bond markets and even Asia high yield, given that, for example, we've seen signs of recovery in China, right? The latest Q1 China GDP growth has surprised on the upside. China grew at a 4.5% in Q1. So that is a very positive signal, given that China has reopened, they have put in place a lot of policy support. And the reopening of China has also positive spillover effects across to the broader Asia bond markets as well. And because of the challenge in Asia high yield markets over the last 1 to 2 years, in terms of the valuations, the asset prices in Asia high yield markets, they're actually looking quite cheap right now, which also means that there's a lot of potential room for recovery in this space.
Thank you, Alice. Right, next question, Ritesh. So I think one of the investors is actually comparing Income Plus together alongside REIT's portfolio. So would you care to give some thoughts on that?
Yeah, absolutely. I think, naturally the Income Plus portfolio, because it is diversified across many, many different bond funds, and each of those bond funds internally are diversified across a lot of underlying bonds, and this is global, right? So when you compare that with, if the question is more on like our REIT Plus portfolio, the REIT Plus portfolio, of course, is much higher risk because it is, number one, only the Singapore listed REITs that we consider in our REIT Plus portfolio. So in terms of concentration risk, you have a much higher concentration risk when you're investing into REITs as a standalone one asset class. And that's where I think when you are trying to optimize for returns and income, don't look at it on a standalone basis, right? You need to really evaluate what kind of risks you're taking. A REITs portfolio will have a much larger drawdowns compared to fixed income portfolios. I think even going back to 2020 and last year, I'm sure in 2020 the REIT market was down, more than 20%, but the fixed income market was not, right? So from that perspective, over a longer duration of time, fixed income actually is much more, safer comparatively, relatively, and is also much more diversified.
All right. Thank you, Ritesh. And I think the last question, I'll open it to the both of you. I think earlier in the investors poll, we also had this question where what's the allocation of fixed income assets would you have in your portfolio? It was pretty low at less than 20% in fact. So in your opinion, what is the percentage of fixed income allocation in a good or rather a well-diversified portfolio? We talk about like time frame wise, 10, 15 and 20 years.
See, I think, again, it depends a lot on individual, individual to individual, what kind of, time horizon they have, risk appetite they have, and all of those aspects. We do have our core portfolios, which are kind of globally diversified. They have certain equity bond allocations. If you go to like very basic math, like, there is this rule of thumb that if you are trying to invest into the market, how much should be your allocation to equities, right? Like, and if you do 100 minus your age, maybe that gives you a guidance, but that's like a very crude way of looking at it. I would say essentially look at it from a drawdown perspective, right? And, that is, I think, a much better way, downside risk perspective, for you to then determine, is that the level of risk that you're comfortable with? Are you able to go through and navigate these kind of volatilities? So if you say that I am like, trying to manage my risk and drawdowns to 10% or 15%, then there is a different kind of allocation that we'll end up with. In our core portfolios, for example, the equity allocation ranges from 20% all the way to 100%. So if you're looking at a drawdown of 10, 15%, then in our conservative or balanced portfolio, the equity allocation is only 40% and 60% is fixed income and gold. Versus if you're looking at drawdowns north of 15, 20%, then the equity allocation naturally goes above to 70% and then all to 100%.
I would agree with all of Ritesh's comments. Just two additions from me. One, of course, is the time horizon. So I think the question here is asking about retiring in 10, 15, 20 years. So the closer you are to retirement, then we do think it's better to have a higher proportion of bonds in the portfolio, because then as you get closer to retirement, then your all else equal, your ability to stomach volatility should be lower. You want more certainty in terms of your income, in terms of how much drawdown, to Ritesh's point, that you can take. So that's one. Second would be, I also think that it depends on which state of the macroeconomic environment that we are in. So I would say that when we are in the earlier part of the economic cycle, when we are in an expansionary environment, naturally you would want more equities in the portfolio, because then equities would generally do better, more upside, and provide potential returns. And then similarly, or rather conversely, in the end of the economic cycle, when we are facing a potential risk of downturn, then that's when you want more fixed income allocation, because again, as I've mentioned earlier, bonds generally do much better compared to equities when we are starting to see a decline in the economic growth. So in our multi-asset portfolio, so we do manage multi-asset portfolios at PIMCO as well, even though our expertise is in fixed income. But in our multi-asset portfolios, we do look at the macroeconomic environment in terms of, like, for example, a traffic light lens. So we have green, which is like in a growth environment, yellow and red. And in our multi-asset portfolios, in the green environment, we would typically actually have about, maybe almost half, like maybe 40 to 50% equities. And in fact, we actually have more fixed income, because like I said, even in a 60-40 portfolio where 60% is equities, 90% of the volatility comes from equities. So in fact, in our portfolios, we actually err on having more fixed income than equities. And in a red environment where we are expecting a downturn in the economy, we actually keep equities exposure from 0 to 20%. So it's actually the opposite of what the poll has said.
Wow, that's pretty interesting. All right. So, okay, in the interest of time, we do have a few more questions, but of course, in the interest of time, I will conclude this segment with this closing statement, which is, if you still do have questions, with regards to the income plus portfolio or with regards to fixed income assets, do feel free to reach out to our client services team, right? They are available on the app, or you can also reach out to the advisory team at Syfe as well. All right, so with that, thank you, Ritesh. Thank you, Alice. I do think we have a token of appreciation for Alice. So, right. Thank you. All right, so here you go, Alice. Thank you very much. All right, I'll just invite you guys to exit the stage. All right, up next, we do have Dhruv, who is our CEO, to actually give us the closing statement. Dhruv, please.
All right, it's great to see everyone here, and thank you for being such an attentive audience through a very interesting session. Now, after spending the years we've spent in Singapore, almost about 3.5 years ago when we started Syfe, understanding the psyche of the users, we've always realized that some sort of dividend-bearing passive income offering has been very, very effective and also quite the need of the hour. If you think of the current geopolitical climate, if you consider the high inflation, bonds have suddenly become very, very, very attractive. Now, this could not be said for majority of the last few decades, to be fair, just because of the interest rates being so low. So it's quite exciting. And as I think my colleague Ritesh always said, the income in fixed income is back. Now, I can't believe you didn't use that line today, by the way. So it's a very good one. So I can take the rights for it today. Now, when we set out to develop this product, we thought, okay, we could probably do it with our expertise. But after working and speaking to multiple partners, seeing the expertise as well as 5 decades of experience that the team at PIMCO brought, it became a no-brainer that we wanted to work with the best. And if you think of this, most of my career being at a tier 1, a big global bank, these are kind of the solutions that we would end up offering to institutions and to ultra high net worths, putting hundreds of millions of dollars. So now this being accessible to a wider audience is actually a great combination of the expertise of an active fixed income powerhouse like PIMCO, as well as the technology and the prowess of a fintech startup such as Syfe. Now, with the launch of Income Plus, as Ritesh was mentioning earlier, this does complete the suite of our offerings as far as passive income's concerned. You could start with something which is very, very low risk, such as Cash Plus. Our last yield is about 3.7%. And then, of course, if you go all the way on the other spectrum with the enhanced PIMCO offering, the yields which get to north of 8%. Within the first few days of launch, we already saw thousands of portfolios being created, and assets have steadily continued to grow since we launched about a couple of weeks ago. So thank you to the team from PIMCO in this partnership, and our special guest, Alice. Some beautiful insights and some very interesting perspectives out there. Bond markets have always been quite elusive. I myself, was an equity trader for majority of my life, so it's a bit of a black box in some ways. But I think with the right kind of partnership, we are taking the magic out of it in some ways and making it a bit more understandable and accessible to a much bigger audience. With the continued support of all of you in this room, we look forward to deliver on our commitment to launch even more exciting products and offerings in the coming months and years. I would extend my personal thank you for coming us today on this fine Thursday evening. Stay tuned for more exciting updates. And if you haven't, I hope there's enough conviction to start your Income Plus portfolio today. Thank you.
All right, thank you, Dhruv. So on the screen right now, we do have a quick feedback survey form. I do have to ask you to just whip up your phone again, scan this QR code for the second time this evening, right? And then just spend 30 seconds to fill it up very, very quickly. Small effort, but it will help us very, very much. So I do appreciate and I thank you in advance for that. Right, I'll just give you guys 5 seconds. So for those who are excuse me, sorry. For those of us who are joining us online, we do thank you for your time tonight here with us as well. We wish you a pleasant evening. Thank you very much.